Chairman of the Regional Council, Chairman of the Direct Tax Committee of Council members, past council members, ladies and gentlemen. It's always a pleasure to be able to address chartered accountants on this very intricate topic, which should not be so intricate, namely the finance bill. In fact, frankly, it should be a bill which only lays down the rates of tax. The rest should come in some amendment act, and we should be able to analyze it a little more threadbare than what we can do in the context of a finance bill. But it has become pattern to try and deal with all amendments which the government would like to introduce at one time at one stroke to the finance bill along with the budget. And I think that is something which we now have the task of analyzing, understanding, and running with. And I'm glad to the WIRC for giving me this opportunity to read the same and discuss it with you. As was mentioned, as far as the rates of tax go, there is very little which has been changed. There is a degree of minor tinkering, some changes in 150, which is up to 12 lakhs, a saving of about 10,000 in direct tax in the direct tax amount, which an assessee would be required to pay. Effective rate of tax may come down from 12.5 to 11.66. And if you consider the standard deduction, then it will really come down from 12 to 11. So therefore, what you are really saying is at 12 lakhs, the rate, effective tax rate is not very harsh. It is something which an assessee can afford to pay, and he can agree to contribute that much to the national exchequer. And that's really what we are trying to achieve. There is an attempt to encourage people to move towards the new tax regime. What is the difference? The difference between the old tax regime and the new tax regime is now something which has been there for some years. But even then, the real difference is only this. We don't want to give deductions linked to savings, deductions linked to welfare. So therefore, you don't have ATC, you don't have Mediclaim, you don't have donations and things like that. But your taxable income and your real income are as close to each other as possible. That is the difference between the old regime and the new regime, where these deductions are not given. However, to encourage people to move to the new regime, for this time, again, a change is being made. Now we have two deductions which are coming up, which are only the standard deduction goes up from 50,000 to 75,000, only if you are in the new regime. And the other change is looks minor, but could be very significant for what you would call the C-suite employees. If additional 4% contribution which the employer can make into the NPS, into the national pension system, and on which the employee will not pay tax. He will, of course, get it only when he retires as a part of his pension. But at that stage, he gets 60% and again. So you have an exempt situation. Namely, today he gets a deduction, so it's an exemption. The income on this, which is there in the pension fund, is not chargeable to tax in his hands. And when he retires and receives the pension, again he is not chargeable, at least to the extent of 60% immediately. Even the balance 40%,
would also be exempt. All that is required is that he will have to use that 40% to buy an annuity, but that annuity could provide that it would be certain for 5, 10, 20, 25 years, and that on demise, principal will be returned. So at that point of time, one gets back the 40% also. So effectively, 100% is tax free. So you have a situation where the whole of it is tax free and a 4% additional deduction which can be made from salary for savings. So this end is a direct saving. The difference again is, as I said, it's a deduction which is available to the employee only he opts for the new system, the new regime. As I said, this is a change of philosophy. The whole idea was not to have deductions under the new regime, to have income and actual income and the taxable income as close to each other as possible. But if you find that you are not able to encourage people to move and you need to nudge them, then perhaps this is something which is required. So, this is a nudge which the finance minister is giving, and one should only welcome it because ultimately it could have been across the board for all, both old and new regime, but it is presently for the new regime. The other changes in relation to foreign companies, a reduction from 40 to 35, is in line with the reduction in the rates of tax and things like that, and the fact that now there is no dividend distribution tax. That dividend tax is being paid by individual assessees and shareholders, not by the company. And since there is no DDT, why should foreign companies pay a higher rate of tax? Even their rate of tax should be rationalized or moderated, and therefore 40 is coming down to 35. Effective rate will be something like 38, but that's a significant difference for them. The changes in LTCG I'll come to. All other rates continue. The major other changes in relation to the STT, the stock turnover tax. Now that's also a change in rates. Effectively, there you have a 60% increase. 0.0625 becomes 0.1%, 0.0125 becomes 0.2%. The effective increase is 60%. Then we are talking about a tax which is insignificant. Ultimately, even if you make a 5% profit, the effective tax of STT will not even be 1%, could be less, depending on how much you make, because it's only on the premium or on the futures price. And because of that, given the small nature, the fact that the 60% increase is there should not matter. It is part of government's philosophy, which we are seeing from what the SEBI chairman has been saying, what RBI has been saying, what each of the regulators is saying, that the stock market is heated, which is acceptable. But the stock market being heated on futures and options, and that too by a large number of retail traders who don't really understand what they are doing, who are only acting on tips and what other people tell them because they don't really have the wherewithal, the time, and the ability analyze as would be required for a real move on futures and options. Because then you are really trying to estimate how the stock will move and do what. Now, for them, since they are being driven to this only with the temptation that there is easy money to be made, perhaps if we can some stopgap in their path, it's worth it. So the 60% increase in STT, whether whether it will really work, one doesn't know. I don't think so. I don't think it is enough to dissuade the retail traders. But one has to wait and watch and see whether volumes come down, volumes don't go down. But volumes may go down because of the other changes which SEBI is looking at, a single contract in in each exchange for each week or each month, and so on. Those changes may be far more effective. This is part of that change which we are trying to achieve. There is a small change in relation to family pension from 15 to 25,000, and that is not really material to us. I've explained to you the change on NPS, and as I said, that's a useful change which we can use. Coming now to what would I would say is perhaps the most important amendment. Important because of here you are changing a method by which taxes have been charged for a number of years, and that is capital gains. You are now doing away with indexation. And because you are doing away with indexation, you are reducing the rate of tax to what one considers reasonable from 20 to 12.5 on long term capital gains. Simultaneously, one is also achieving the second amendment which was required, that the period of holding in order for an asset to be classified as long term is being standardized. So now you have only two periods, 12 months and 24 months. 12 months for listed securities, 24 for everything else. So real estate, jewelry, call it what you like. All other capital assets would fall under that 24-month formula, and listed will fall under the 12-month formula. So that I think this change, the standardization of the time, was something which the market wanted. You didn't like something 12, something 24, something 36. And the fact that you have to look at then again section 54, 54F, and all that, it becomes a very complex mechanism. Now, in a sense, you have a rule of thumb in your mind. You know your capital asset, the capital gain, roughly you know what it is, and you know 12 and a half is the tax. And you don't really worry about period because 12 or 24 months is not so long a period for you to wait for it to become long term. So, in that sense, it makes life much simpler. That is the major advantage. Major disadvantage seems to be doing away with indexation. Nobody is very clear which of the two is better. And the answer is depends on how long you were holding the asset and what is the yield. If you were earning 14, 15% on the asset, in the sense appreciation, we are not talking about yield but appreciation, then naturally this new regime will be far better because you will only pay 12.5% tax on a significant capital gain, because if you are talking about a 14, 15% appreciation every year, your capital gain will be large and you will pay a lower tax. If, on the other hand, you were unfortunate and the appreciation was only 5, 6, 7%, you will find this disadvantageous because while earlier perhaps you would have paid no tax because the indexation would have taken care of the appreciation. Now you will go ahead and pay a tax on what one would therefore say is a notional gain. Because if you adjust for inflation, you have not made a profit. Your money is still worth what it was when you invested. So, adjusted for inflation, you have not made money, and yet you will pay tax at 12.5%. So, that's a negative. What is going to be the benchmark which between the two? Again, as I said, it depends on the period, how many years you have been holding, and what time. But roughly, it looks like anywhere between 8 to 11% would equate the two. Appreciation of between 8 and 11% will mean that your 12.5% tax is equal to the tax which you would pay after indexation. So both will be on par. There is a lot of speculation as to what this will do, in particular to the real estate market. And secondly, to the stock exchange. As far as stock exchange is concerned, one will have to accept the fact that 10 has become 12.5. One is going to pay more. There is very little which assessees can do in respect of this. So whatever be the capital gain, that will be taxed. You may accept this 25% increase. It's not all that large. In relation to the capital gains rates prevailing elsewhere, UK charges between 10 and 20, US charges between 15 and 20. So capital gains rates are in this range in most economies. So keeping that in mind, 12 and a half is perhaps an acceptable number. The negative is that this is now equally applicable to non-residents. Earlier, non-residents had a better formula in most cases. They had, for example, in relation to unlisted stocks, only 10% even for them. So they were given a benefit. Most economies, UK, US, well, I spoke of the rates of tax, would not charge the capital gains tax to non resident investors. They encourage non resident investors to come into their economy and put their money without charging them a tax. Now we would charge the same rate even to non resident investors. So that's an area which perhaps over time will have to be reviewed, because ultimately the FIIs of the world and the non resident investors have a choice of where to put their money. And while the Indian capital market is giving a very good return and is attractive, and the growth rates which India is achieving is a strong reason to come to India and to invest their money, the rate of tax will reduce that yield. And if elsewhere, in a tax free manner, one can earn the same thing, say, on NASDAQ as one is earning on BSE or NSE, then the choice will be between investing in NSE and paying 12.5% and investing on NASDAQ in the US and not paying the tax. So, non resident investors will select where to put their money. Resident investors, certainly, as I said, the rate which is being charged may find it acceptable. The short term capital gains rate is being increased from 15 to 20, but this is applicable only to three items: listed equities, listed business trusts, basically, and units of those of that nature. So short-term capital gains is a very limited item. Listed equities is the main thing. The rest really is not of great importance. All other items, debentures, bonds, debt funds, whatever else you have, there is no separate short-term capital gains rate. You will pay the same slab rate which you would otherwise pay. So it's not as if there is any special formula for them. So if you are at 25%, you'll pay 25. If you are at 35, you'll pay 35. If you are at 39, you'll pay 39. So it depends on where you are. The other major change in relation this area is on 50AA. There is one small change on cost in relation to capital gains, but I'll come to that a little later. So as far as period of holding, etc. is concerned, 50AA is the other change. Last year, debt funds and market-linked debentures were put under 50AA. So the assumption was, the deeming fiction is that as far as they are concerned, whatever period you hold them, 10, 12 months, 24 months, 36 months, 48 months, whenever you sell, it is short term. It remains short term for life. So it will never become long term. You will never get the long term rate. Normally, it should make no difference, because debentures and debt items, you should really be earning an interest from year to year. The appreciation should be almost nominal, 1 or 2%, if at all, and that too depending on how the yield rates in the market are moving. So then it makes no difference whether you call it short term or long term. The effective tax rate is not material. Why is it material for these two items, for market like debentures and debt funds? It became material because this was an arbitrage. It was an arbitrage that you make a debenture which is going beyond 36 months, say 39 months, and then make it market linked so that you give a appreciation which is really a substitute for interest. But because it becomes capital gains, you pay a lower rate of tax. You pay only 10 or 20 as it was last year, and now it would be only 12.5 if it was long term. So naturally that arbitrage would mean that something which normal income would have been charged at 25 or 35 is being charged at a much lower rate. But arbitrage can't be permitted because that is not the intention. If other debt instruments are paying full rate, there is no reason why these debt instruments should pay a lower rate just because of some structuring. So they were brought into this deemed short term concept. This year we have added unlisted bonds and unlisted debentures to that. So, as far as that is concerned, you are making it clear that virtually, except for listed debt instruments, all debt instruments will be deemed short term. It's a question mark. Why listed debt and unlisted debt is dealt with differently? A listed debenture will have only a 10%, a 12.5% rate of tax after 1 year, after 12 months, when it becomes long term. An unlisted debenture will have the normal slab rate. Even a listed debenture is ultimately a debt instrument. The company is getting a deduction for the interest it pays. If the company is getting a deduction for the interest it pays, and the assumption is that therefore the holder should pay the full tax, then there is no reason why this benefit is given to listed debentures when it is not given to unlisted debentures. The purpose is only this, that in unlisted debentures, all forms of structuring like market debentures, premium on redemption, 36 months, maturity, and so on were attempted. In the listed debenture, you have dealing with the market, so the normal terms are reasonable, and therefore the chances of such extraordinary structuring are few and far between, and therefore listed debentures continue to have, for the sake of simplicity, that all listed securities fall in one class, they continue to remain at 12.5%, unlisted go into a different class. There is going to be, there is the other area of the 50AA amendment was last year. The debt funds were defined in a very peculiar way. They were defined not with the debt which they hold. They were defined negatively that they have less than 35% interest in equity. The assumption being, therefore, the balance 65 is in debt, and therefore they are a debt fund. But because of that drafting, a number of funds which were not meant to go into 50AA went into 50AA, like gold funds, exchange traded funds, fund of funds, etc. These are cases where you don't hold equity because there is no equity to hold. Your real risk is on equity. Your real risk is not a debt risk. These should have come out of 50AA. They are being taken out. The definition is being changed. Now the definition is a positive definition. The debt fund must hold more than 65% debt. So with that positive definition, all these other funds will come out. But that removal has been delayed by 1 year. It will only apply from financial year 25-26. As far as this year is concerned, till March 25, as these funds, funds of funds and ETFs will continue to remain under 50AA. And if you sell them, they will continue to remain short term. But from next year, this problem will be resolved. Then this will perhaps create some problem for compulsorily convertible debentures, optionally convertible debentures, etc. Because these will also be short term by definition. They are unlisted when they are unlisted, and there are very few, virtually no listed OCDs that one can find, because they will be deemed to, the real underlying interest is equity, and yet they will be short term in an OCD situation. This will have, you will have to be careful. You will have to decide. By and large, you will not be able to dispose of the OCD as an OCD. You will have to wait till you convert it to equity and then sell the equity. When you sell the equity, you will come back to 12.5% as opposed to the short term slab rate. So you can reduce your effective rate of tax, but you have to wait till you get the chance to convert and do it post conversion. The other area which is going to have some degree of uncertainty is on how this will be dealt with for non residents. Is a debt instrument giving rise to interest income, or does it give rise to capital gains? It should give rise to interest income. You have a deeming fiction under 50AA which says it will give rise to short-term capital gains. That's a deeming fiction. That deeming fiction applies to India, applies for domestic tax. But as far as the DTAAA is concerned, as far as an investor coming in from UK or Germany is concerned, he has got a double tax treaty to look at. And under the double tax treaty, there is a lower rate of tax on interest. Then he claimed that he should be entitled to that benefit, that he should pay that lower rate of tax on interest income because that is the rate specified in the treaty. And the treaty definition of interest is wide enough to cover such an instrument. So will the treaty definition override the domestic law definition, where domestic law deems it to be capital gain, but the treaty deems it to be interest? We will have some litigation on that. Then the 112A has been increased from 1 lakh to 1.25 lakhs, the exemption for long-term capital gains. The only uncertainty is you have a break in the year, 23rd July. All sales before 23rd July are at 10%. All sales after 23rd July are at 12.5%. Your 1.25 lakhs is for the whole year. Which part will you attribute to the sales before 23rd July? Which part will you attribute to the sales after 23rd July? That is not made clear. We have only made clear that it applies to the whole year. Naturally, I think you will go back by the rule which says that when you have an option, you choose the method which gives you the least tax. Least tax would allow you to take 1.25 exemption on sales after 23rd July, where the rate is 12.5. And only anything left over you would go back to sales before 23rd July. Therefore, the question arises, what is the date on which you say you have sold? Technically, this can only be for people who have put in an order to sell on 22nd and the broker has implemented on 23rd or 24th. Will he get the rate for 22nd when the rate was 10%? Or will he have to pay the 12.5% on the time when the broker has implemented? The CBDT's own circular says it is the date of the contract note. So the contract note will decide. If the contract note is dated 23rd July, it is 23rd July. That is what will decide the rate. As I mentioned, there is one other issue on cost, which is in relation to 55(2) AC. This is correcting an anomaly. You had shares which were unlisted, and of which unlisted on January 18, because 55(2) AC grandfathers listed shares to the January 18 price. So those shares were unlisted on that day. That company is going for an IPO today. When it is going for an IPO, some part of the promoter shares are also being sold, say in an OFS, as part of that IPO. That OFS is liable to STT. Because it is liable to STT, technically those shares should fall under 55(2) AC. But under 55(2) AC, you don't know the market price on January 18, because there was no market price on January 18. So that is unknown. The argument taken was, consequently, the section does not apply. It is not possible to work out the cost. Because I cannot work out the cost, I will pay no tax. So the simple solution, because following Srinivas Shetty and their principles, that if you cannot do a computation, if the computation mechanism fails, not liable to tax. So in those cases, the argument taken by some assessees was that we are not liable to tax, because cost cannot be worked out by the formula prescribed. They have therefore made it a retrospective amendment. This is one of the only retrospective amendments, retrospective to 18, saying from that day onwards, these will be deemed to have a cost equal to the original cost plus indexation up to 18. So you get your original cost plus indexation up to 18. That will be your cost. You don't have to worry about the market value in 18. So therefore, this possibility of arguing that it is not taxable goes away. Then that's us coming to the other change in capital gains. It's a technical tinkering. One doesn't know whether it will be effective. One doesn't know why it is being done. I don't think it was. It was perhaps misused once in a blue moon, but I think the misuse, if any, was insignificant. The point is, how often do companies give a gift of capital assets? It's by and large unheard of. But yet you have amended 47.3 and said that a gift is not a transfer for the purpose of capital gains, is not chargeable, but hereafter only gifts by individuals and HUFs are not chargeable. Meaning a gift by a company would be chargeable. So therefore you are now making gifts by companies chargeable. The reason why I'm putting in all the caveats is you are opening a whole new can of worms about litigation is good for accountants and lawyers. I'm not sure it's good for the government. It's not sure it is achieving anything. Because when I give a gift, when the company gives a gift, what does it get in return? Answer is nothing. It is supposed to be without consideration. Otherwise, it is not a gift. If they get nothing, what are you going to charge the capital gain? So what has that been done? I mean, government is not unaware when they make this amendment. So what have they done? In the explanatory memorandum, they have referred to two sections, 50CA and 50D. They have said, we have introduced 50CA to deal with cases where the consideration is less than the fair market value, and 50D to deal with cases where the consideration cannot be determined. So all those cases are now covered by one of these sections, and yet companies are arguing that the shares gifted by them are not taxable. So though we have introduced 50CA, though we have introduced 50D, assessees are arguing that those sections don't apply. They have not gone ahead and said that those sections apply. They have said because assessees are arguing this, we are taking away the exemption from 47.3. Does it mean that 50C and 50DA will become applicable? If they don't become applicable, that argument will still remain. If there is no consideration, if it is a sale without consideration, I mean, it's not a sale, it's a gift without consideration, there can be no capital gains tax necessarily. It has been litigated a lot in the sense you do have tribunal decisions in Bennett Coleman, in Tata Sons, where this type of issue has been dealt with in the context of reduction of capital, where again the company has cancelled shares without paying anything. Tribunal in Bennett Coleman did not consider that to be a transfer liable to capital gains. In Tata Sons, they considered it to be liable. There, of course, it was a case of loss and the loss was allowed. So you have conflicting decisions. Tata Sons has considered Bennett Coleman and then come to that conclusion. Therefore, this litigation between Bennett Coleman, Tata Sons, the distinction, if I may use it, is very, very esoteric. If the consideration is nil, it is still consideration, 50D can apply. If the consideration cannot be conceived, if consideration does not exist, as opposed to saying it is zero, both really mean the same thing. But if consideration does not exist, then the Tata Sons ratio will not apply. So you need to find out whether it is zero or it does not exist. And as I said, that's a distinction which in each case you will go to the High Court or Supreme Court to find out which of the two is true in the facts of this case. There would be, of course, a number of situations where companies are involved in this, like a family arrangement. Very often you do ask companies to also give away some asset. It could be a plot of land, could be a building, could be shares to some family member as part of the family arrangement. There is a line of decisions. Bombay High Court has taken the view company cannot be party to a family arrangement. Shareholders can be. Only family members can be. But the other view, therefore, was company is getting no consideration, it's only gifting, therefore, it is not taxable, even though it is under the family arrangement. That would not, now, would it continue to work? Is it a case of non existent consideration or is it a case of nil consideration? That's what you will have to evaluate, as I said. That's the type of case. They themselves have introduced 46A in the context of buyback, where the deeming fiction says the consideration is nil. So the act assumes that there can be consideration which is zero. The difficulty also is the act requires that consideration must accrue or be received. How can zero be received? How can zero accrue? How do I say zero has accrued or zero is received? But yet they are providing for it. So, as I said, this will only lead to litigation, but in esoteric cases, let us not. In cases of mega corporate restructuring, I would think there is consideration even today, though we may say it's a gift, it's not a gift. The gift is the consideration is the fact that the group as a whole is achieving some restructuring. Either company is becoming bigger, smaller, whatever. If that is true, then the moment there is consideration, you come to 50D. Consideration is not determinable, the fair value of the asset, and charge tax. So that would happen even today. For that, you don't need a 47.3. In Reddington's case, Madras High Court has in fact charged it when they tried to do such a restructuring. The tribunal gave them the exemption, but the High Court has charged it. So therefore, that is true. Maybe this has come up. Why has this come up? One of the points is the recent newspaper article. This could be one of the reasons why, where some founders of startups managed to get a gift from the non-resident founders who had invested originally. So let's say the startup founder himself was holding, say, 30% or 20%. The investors were holding 60, 70. The startup has done well. They are happy with him. And they therefore agree to give him another 10% out of their holding to encourage him to continue in that fold. That 10%, is it a FEMA violation and is it liable to income tax? Both are issues which are pending. Now, this is an example of a corporate gift which is sought to be covered by this amendment. Whether this would therefore have the effect of charging such a transfer. Then turning to buyback of shares. That is the other area where again we are changing the mode by which the transaction is taxed. In a buyback of shares, the company is taking back the shares and paying off the shareholder. It would normally mean the shareholder is selling his shares to the company. If he is selling his shares to the company, he should pay capital gains tax. That's the norm. That is what section 46A also prescribes under the Act. However, 1034A was introduced for simplicity, that instead of charging the shareholder, you would charge the company. So 115 QA charges the company on the buyback, and the shareholder was given total exemption. So 1034A says shareholder will not pay capital gains tax, he will not pay dividend, he will pay nothing, and the company will pay tax on the buyback. So ultimately, government was getting its money, and it was easier to collect it from the company than from the shareholder. So that was the scheme of tax. Now we are changing that scheme completely. Now we are saying, and we are going, of course, to the absolute opposite extreme. Now again, the shareholder is as good as selling his shares. Let us say the shareholder has a cost of 80 rupees and he is getting 200 rupees on the buyback. His profit is only 120. But instead of charging him on 120 when we are going back, we are saying we will charge him on the entire 200. Forget his cost of 80 rupees. He will have to pay tax on the entire 200, and he will have to pay tax on the entire 200 as dividends. not as capital gain, which means the full rate of tax. So effectively the slab rate, so much a higher rate. What is being given as a solution is, all right, you had a share worth 80 rupees, you got 200, but that 200 has been taxed as a dividend. That means your 80 rupees is a dead loss because the share is cancelled. We will allow that 80 rupees to you as a long term capital loss. So that is being allowed. Long term capital loss cannot be set off against dividend. So you will still pay tax on 200. If you have some other capital gain, long term capital gain, you can use this loss of 80 to set it off. If you don't have it, bad luck. You have 8 years to earn long term capital gain and set it off. If this was your major asset or your only asset, then you will get nothing out of it. So that is what effectively one is saying. This is coming in from 1st October 2024. Perhaps we could see a spate of buybacks in August and September. Because in August and September, the buybacks will therefore still continue to be taxed at about 18.5%, 18.9%, and that too in the hands of the company, as opposed to the shareholder. This whole negative charge by which it will become dividend is effective 1st October. It's possible to achieve a buyback within 2 months. You have the months of August and September, putting in effort in the company law given the procedures and the formalities. In smaller companies where shareholders and the company promoters and all know each other, and you can therefore get, say you give an offer, you are supposed to keep it open for 15 days, but shareholders can accept it in a day. 15 days is the minimum you must keep it open in that sense. Now that is true of a listed company. You must give shareholders a chance to make up their mind. In a closely held company, your shareholders will accept it in 24 hours and so on. So with that type of speed, you can easily achieve it in this 2-month period. So you may have a spate of buybacks in this period. The other is that will this apply to all cases? Some situations will still stay out. This amendment will not apply. One is foreign shares. If you are holding the shares of the Indian company is holding shares of a foreign subsidiary, or the Indian shareholder is holding shares abroad, that buyback is by a foreign company. That is not a buyback in accordance with Section 68 of the Companies Act. This applies only to a buyback in accordance with Section 68. Therefore, that buyback will be out. So foreign shares will be out. They will continue to be taxed the way they were taxed in the past. 1034A will not be available. So you will have capital gains and deemed dividend depending upon the amount which is paid. There could be redemption of preference shares issued for cash. If the shares were issued for cash and you are redeeming them, that is not a buyback in accordance with Section 68. That's a redemption as per Section 55. So that will stay out of this because they have notified the section which has to be applied. One of the planning which number of foreign companies had done in the past when this was available and before 1034A came in, and one reason why it came in was that they had the same language. Buyback was chargeable and if it was under 68 or 77, the old act. They said we will go under 230 or 391. We will do a buyback, but we will do it by using another section of the Companies Act. Because we are doing it under another section, this provision will not apply. Can that still be done? 230 is still available. I would think no. That loophole may no longer be available for the reason that the language now is in accordance with 68, not under 68. And 230 has an explanation which says that any buyback under 230 must also be done in accordance with 68. So even if you apply 230, you have to do it in accordance with 68. So because you will still apply 68, that whole litigation which was there You have Cognizant, which gave 19,000 crores. In this manner, you have Cap Gemini, Bombay High Court, all those. That litigation hopefully will not resurface, because now the language is such that both 68 and 230 may be caught. It won't help whether you use one or the other. There are These are clear areas. Then there are slightly gray areas as to whether this will apply or not. Like a preference share issued on a merger. If it is issued for cash, there is no debate. The redemption will not be taxable. But if it is issued on merger, is it issued for cash? And the answer, I would say, is yes. And that's what the tribunal have taken the view, because it is for value. It may not be cash, but it is for value. And being for value, tribunal in Parle Biscuit, Uday Pradhan, etc., have taken that view. So therefore, in those cases also, the new provision should not apply, because it's still a redemption of preference shares. So therefore, again, as usual, one starts thinking whether we can do something creative. It's going a bit too far. Time will tell. When I convert equity shares to preference shares by an NCLT scheme and then buy them back, because then preference shares redemption will not be charged under the new section, it won't be dividend. One will have to see. In the days of war, I don't think one can easily do that. The general anti-avoidance rule will come up. You will have to explain why you are doing what you are doing, what is the commercial rationale, and it may be very difficult to find commercial rationale for it. The tax rationale won't do. Therefore, that type of thinking will come up. Here again, we will have, under the double taxation agreements, spate of litigation on whether this dividend is a dividend or it is capital gain. As I said, whatever the company pays is now being charged as a dividend. That's a deeming fiction. The deeming fiction can only apply for domestic tax. Can it apply for the treaty? The treaty type defines dividend as any profit, any return on shares, the income on shares. That's the language which it uses. So, even a buyback is an income on shares. Is it therefore a dividend even under the treaty? But a buyback is also an alienation of movable property. And under the treaty, alienation of movable property is a capital gain. So we are going to have this area which will have to be litigated. It will also depend upon, does the company have profits? Does the company not have profits? And there is a slight difference in the definition of dividend versus definition of interest in treaties. The definition of dividend includes income on shares, but it also includes anything which the domestic law treats as dividend. But it talks of a corporate right which domestic law treats as dividend. Whether the buyback is a corporate right. So anyhow, this will, something which over the years, as I said, high courts and Supreme Courts will have work to do. We cannot try and resolve that today. We can only note this is going to come. You will have planning coming up. Startup which is in difficulty may, in fact, ask a new investor to put money and use that money to buy back the old investor, and so on. So that type of thing will come up. Especially buyback is one transaction which does not have a stipulation of arm's length price. Of course, if it is with a non-resident associated enterprise, it will still be there. But with a domestic transaction, it won't be there. So you can, let us say the share is worth 100, or in my example, 80 and 200. If for some reason you want to, and the shareholders are happy, you buy it back for 20. Then only 20 will be charged as dividend, and the shareholder will still get a loss of 80. Now, if the shareholder needs that loss of 80, he'll be able to use it. So you can buy it back for a token sum. So that type of things one will have to evaluate whether that works. we share the share company, if it's a company who's the shareholder, receiving this 20 rupees dividend can claim ATM. It can in turn give dividend to its shareholders and claim ATM because this is dividend income. So if it's an individual, he will not be able to do it. The company shareholder can do it. An issue will come up because it is deemed dividend under Income Tax Act. Is it dividend under FEMA? Because under FEMA, a non-resident can remit current income. So dividend can go out without limit. Neither that 250 or the 1 million limits would come in. A non-resident can take his money out if it is current income, if it is dividend. He cannot take his money out if it is a profit on sale. That is not available. That will go within the 1 million rule. 1 million, of course, he can take it out every year, but it will go within the rule. Is this because it is deemed to be dividend under income tax? Will it also be taken to be dividend for FEMA? That's another issue which will have to be examined. And of course, we as accountants, just because it will be deemed as dividends under income tax, in accounts, though, it will have to what it is. But it is a price you have paid for shares. It's not that you have distributed profits to shareholders. So accounting will not be impacted by this. The Companies Act will not be impacted by this. This is something which is only for the purposes of the Income Tax Act. These, I think, are the 3 amendments which we were concerned with this year. The other amendments are more informative. The Vivad Vishwas scheme which has come in, which we wanted. As the ICI just mentioned, Chairman ICI Direct Tax Committee, it was something which ICI was representing for. The problem is there is a backlog at the Commissioner Appeals level. Appeals are not being decided. Vivad se Vishwas could be an answer, but it's not a real answer. Because the answer requires you to pay the full tax to get out of paying interest and penalty. So what are we saying? We are saying that in 2021, I assessed you 200 rupees tax. You went in appeal. I didn't decide the appeal. That appeal is pending. Your 100 rupees is growing every day with interest. Your 100 rupees is going with penalty. Today that 100 has become 200 or 250. Now I'm giving you the option, pay 100 and I will forego the balance 200 or 250, which it has become, the balance 100. Why did 100 become 200? You didn't decide the appeal. I had filed the appeal within 30 days. Your officers didn't decide the appeal. 100 became 200. Now I'm giving you a concession that I'm happy to take only 100. But why would an assessee pay that 100? The reason why he went in appeal is he believed that 100 was not payable. So except in debatable cases where the assessee is not so sure of himself, whether he would win that appeal or lose that appeal, which would be true of 5% cases. I'm not saying no, but I don't think it will be true of more than 5% cases. The balance will not be inclined to accept this Vivad severe the scheme in this time period, just as in the earlier period. It did have a reasonable success. What was that success? In 2020, there are 2 different numbers prevailing. There was a newspaper article earlier of 21 which said perhaps 54,000 was recovered. Recently, the chairman CBDT in some interviews has been saying around 70,000. We don't know, but let's assume it's between 50 and 70,000 was the recovery which the government made. What is the outstanding disputed tax in appeals? It is anywhere over 10 to 50, 12 lakh crores at least. So against that, what have you really achieved in the Vivad se Vishwas? And perhaps all the low-hanging fruit was captured last year. I don't know whether there is more low-hanging fruit which will be captured, because a lot of the assessments in this period, because major part was faceless, have also been excessive assessments at times. Unfortunately, faceless assessments, our experience has been you have a lot of assessments which are unreasonable and arbitrary. Nobody is going to pay that unreasonable arbitrary tax just to get out of litigation. In that case, The backlog will continue. Whatever little is reduced will be reduced. Let us see what time will tell how much is reduced. You have various things. You have to do it something before December, then you pay 100. If you do it after December, you pay 110. If it is a penalty appeal, you pay 25, or otherwise you pay 30. So the percentages are all prescribed. It's all there. The procedure is there. It is simple. It is not complex. But you will have to file the forms and take this advantage. If you have already paid tax in excess of what you have to pay under the scheme, you will even get your money back. So this will work, but with a limited benefit. Then turning to the search cases, another area where, as was mentioned, we had one way of taxing search cases till 2001 or 2003. We changed it in 2003. We had another way. We again changed it in 2021, and we are again changing it in 2024. Each time, the explanatory memorandum says the current scheme is not working. The 2003 scheme is not working, so we are changing. In 21, you say the 21 scheme is not working, so we are changing. And the 24 memorandum again says the current scheme is also not working, so we are reconsidering going back. So we will go back. That's what it is. There's an interesting offshoot of the search case provisions, which we may have to look at. Perhaps this time it is a little more of an amnesty than in the past. One will have to carefully study it. I'm only giving what my prima facie reading tells me is that in a search case, now you will be assessed for a block of 6 years jointly. There was a question that how can you assess for 6 years? Earlier, if there were 6 assessments, part was disclosed, part is undisclosed. They have dealt with that. They have said they will assess for the entire 6 years in one assessment. Tax will be charged on the part which was already disclosed at the old rates, and tax will be charged on the undisclosed part at 60%. So you will divide one assessment in 2 parts, but different rates will be charged. So that is provided for. In addition to 60%, you will have to perhaps pay cess, but there is no surcharge. There is no interest. And if you voluntarily file the return after the search and accept to pay this 60% and don't go in appeal and pay it off, there is no penalty. So effectively, for your undisclosed income, with a payment of 62%, you get out of all interest, penalty, all other botherations. You just pay that tax and be at peace. Now, depending upon the type of facts of the case, there would be those search cases where people would naturally be inclined to take advantage of this. And this is what the explanatory memorandum tries to say in so many words. No such penalty shall be levied if the assessee offers undisclosed income in the return furnished in pursuance of search and pays the tax. And you have 60 days to file the return. So from the day he gives you the notice, you make up your mind. Is it worth paying 60 and being done with it? Or do I want to fight with them? And that litigation will last for the next 5, 10, 20 years. I may finally win because I believe I'm right, and I won't have to pay that 60. So we have to decide at that point of time. Changes on reassessment. Another example, like search case, reassessment also has been quoted as an example of the proposed simplification of the law. So this is a part of the proposed simplification. What is the change? You have substituted existing section 148, 148A, 149 by new sections. What is the change? The sections have been changed. The language is different. There is no change. So it's only the English which is different. You ultimately come back to the same position. The 148, 148A and 149 are more or less saying the same thing. Minor differences. The minor difference and the major part of the minor difference is the outer limit under 148 and 148A was 10 years. Now that is being brought down to 5 years. So that is a real significant change, simplification. The change in language is that now you have a show cause notice which has to be issued within 5 years, and a actual final notice. First is the show cause notice. Why should you not be given a notice under 148? And after you reply to that, the officer will pass an order saying that this is a fit case for issuing 148. That final notice will come in 3 years, 3 months, or 5 years, 3 months. The normal rule is 3 years. 5 years is the extraordinary rule. 3 to 5 is supposed to be special. It is supposed to be applicable only if there is evidence with him of an asset, of entries, or of expenditure in respect of a transaction which is undisclosed, and if it crosses 50 lakhs. So both this criterion have to be satisfied. Only then you have the 5-year rule. Otherwise, it's the 3-year rule. The sources of information are specified. So he cannot get any other information to charge you. Those sources are well known, and there is basically anything coming from the risk management strategy, any audit objection, a gray area which has led to some litigation. Because in audit objections, you have a preliminary audit objection, then the officer replies, then that audit objection becomes final, and so on. When do you say it's an audit objection? Because the way the department works, in 3 years, you will not have a final audit objection. You can have preliminaries, but final audit objections don't reach. And if reopening is limited to 3 years, then audit objections may not be there. Then you have double taxation agreements, information from foreign countries, and surveys. So virtually very limited scope for reopening. There is only one section, 135A. Anything coming up out of that, he can reopen even without giving you a notice. That's the one difference. 135A is the electronic method by which information is collected from banks, brokers, all the agencies, and checked with your tax return. And if there is a discrepancy, that discrepancy can lead to a reopening. And that reopening virtually can come without a notice. But it's not really without a notice. What happens is, for the electronic verification, when they find data which is different from your return, they are required to give you a notice. They do give you a notice. That's not a reopening notice, but a notice telling you that the electronic data which government has got shows that you have sold 1,000 shares, whereas your return is showing you have sold 200. Please explain. And you will get the chance to explain why 200 is correct and not 1,000. If you have succeeded, that's the end of it. If you have not, and they are not satisfied with your explanation, then because they believe that you sold 1,000 shares, they will reopen the assessment. That is the type of case which will reopen under 135A. You have changes in relation to TDS. The explanatory memorandum itself says there are 7 different rates of TDS and innumerable sections under which there is TDS. As a means of simplification, out of that, in about 6 cases, we are changing 5% to 2%. Both 2 and 5 are part of the 7 different rates. So you are now making an internal change from 5 to 2, but you still continue with 7 different rates of TDS, because some of them continue at 5. All 5 is not changed to 2. So it's not as if there is one rate is eliminated. So effectively, what simplification have you really achieved? Not much. The only simplification is, if it is 2%, sometimes you don't mind paying that or paying the penalty on that, etc., not complying with it. It's still a cost, it's still a compliance cost. It's still something which one has to do. So I don't see that as, again, achieving a lot of simplification. This is the attempt. Let's hope this is a beginning, because that's what they say, and that over the next 1 or 2 years, we really reduce the rates of TDS, bring it down to something which is manageable. Because why should assessees have this whole burden of collecting tax for the government and making it available to the government? And for that whole compliance of paying the TDS, paying the challan, filing the returns, knowing the rate section under which you are doing it, does it fall under 194C? Does it fall under 194J? What is applicable? A mistake in that can again hurt you, and so on. One clarification they are issuing this time is under 194J, originally it was for professional services and the rate of TDS was 10%. Then the difficulty was that 194C provides for work done and the rate of TDS is 2%. Professional also does work. He doesn't get paid for doing nothing. So then when he has done work, do you say he falls under 194C for work done and deduct 2%? Or do you say he falls under 194J and deduct 10%? That was the difficulty. So then they amended 194J and they said technical services under 194J will be 2%, not 10%, unless they are professional services. So now you have to distinguish between what type of work the professional has done. Is it quality professional work or is it something which is administrative? So has he done a compliance thing? Has he filed my GST return? 2%. Has he advised me on GST? 10%. So you need to be able to distinguish between the two and decide which rate of TDS you will apply to that particular invoice. The difficulty was that 2% under 194J for the compliance part. Is it also under 194C? Because it is work done. So now they have clarified. No, it is no longer under 194C. Anything which falls under 194J will be taken out of 194C. So, I mean, this was a requisite clarification. It has come. Some dates have been changed for the date by which you must file so that you cannot be prosecuted and all. But it's only a change of dates, nothing material. In relation to partners and partnership firms, two changes. One change is that the amount of remuneration which the firm can claim as a deduction has gone up from 1,50,000 to 3 lakhs. And the profit on which you can claim that is that is the minimum, irrespective of profit. So to say, even in a loss situation, you can claim 1.5 and now you can claim 3 as partner's remuneration. So let's say the firm is earning also only around 3-4 lakhs. You could claim this entire 3 lakhs, assuming the partners are not taxable. The partners will not pay tax. The firm will not effectively pay tax. It will come down to a small profit. So that type of situation would work. And because this limit has been increased, one gets an extra deduction possibility. The maximum difference, because otherwise also you are entitled to 60% over and above that 1,50,000. So the difference by getting extra 1,50,000 is benefit of an additional deduction of 90,000 at the maximum. So it's not an earth-shattering number. It's not something which is going to make a huge difference. And along with that has come the negative, that now you have to deduct tax, TDS on all payments of remuneration and interest to partners. So that 150 or 3 for which you are claiming, you have to deduct TDS. If he is not taxable, he must go and prove he is not taxable, get a no tax deduction certificate. Otherwise, which is going to be very difficult. So you will deduct and he will have to go and claim a refund. So that's a hassle which is going to come up. And the bigger hassle is you pay remuneration on the basis of 90% of profit which is allowed to 6 lakhs. That's what your estimation is that you will make the profit. Unfortunately, come March, you find that you have earned only 4 lakhs. You have not earned 6 lakhs. You have paid off 5,40,000 to the partners, but you could now pay only 360 because out of 4 lakhs, you can pay only 90%. 180 is paid extra. You will not get a deduction. That's fine. On that 180, you have already deducted tax. Now the partner will file his return. He will show an income of 360. He cannot show 540. because he can only be taxed on 360. So now you have a situation where the income returned is 360, the TDS is on 540. Will he get a set off? Or will they say, no, you have not offered this income for tax, you can't get a set off, so that TDS is gone? Cannot be. But on the face of it, again, a difficulty which will come up. You will need clarifications and so on. It will come. This is not intended, but a possible consequence. You have a TCS on luxury goods at 1% coming up. Today it's only on motor cars. On where you buy a car worth more than 10 lakhs, you have to pay 1% TCS. Now it will be on luxury goods to be notified. Could be bags, could be crockery, could be jewelry, could be anything. We'll have to see what government believes is luxury goods. Luxury goods is the name given in the explanatory memorandum. The act is only talking about goods costing more than 10 lakhs. You have the amendment for charitable trusts. You are combining that section 10 and section 11. It's a procedural amendment. It's not really material. It's going to make a huge difference only this way. All the section 10 trusts will now again have to reapply for registration under 11. They have been given time up to the date on which their current approval will lapse. So if they have a 3-year approval, they have 3 years. But whenever their approval is going to lapse, it will not be renewed. They will have to reapply under 11 and get the fresh registration under 11. So paperwork, no change, because the exemption under 10 and 11 are equal today. 5 years back or 10 years back, there was a significant difference. The exemption under 10 was far better than the exemption under 11. And therefore, people were working on that. Today, as was mentioned, with 23 provisos to 1023C, the exemption under 1023C is exactly the same as the exemption under 11. So therefore, there's no difference between the two. All that you have to do is go through this paperwork and file. One other amendment is coming along with that. They are saying two trusts can merge into each other, provided they comply with the section which is now being introduced, 12AC. And if they comply and they merge, they will not be charged. In the sense, it will not be deemed that one of them has given up its registration, because if a trust gives up registration, then under 115 TD, the entire assets of the trust are charged to tax at that point of time. So that deeming fiction will not apply. It's a good amendment. Was it required at all? 115 TD already has that exemption, saying that if two trusts merge and their objects are similar, they will not be charged. So why do you need another section? So really, what is the section doing? The section is doing that it is now giving the board a power to give conditions, notify conditions which the merger must imply, failing which the merger will not be exempt. The question is, I will not be exempt under 12AC. What is the consequence? I have to be charged under TD. But under TD, there is no condition. There is no section about conditions under TD. So even if I'm not exempt under 12AC, can you charge me under TD? Perhaps not. So therefore, whether this amendment is of any use, we'll have to see, unless they amend TD along with this, which they have not done just now. The amendment to 56727B, the angel tax, as we were told, that has gone forever, gone completely. One can never say forever because anything can come back, but it is gone at the moment. However, the second part of it, section 68 continues. If your shareholder who has invested money is unable to explain his source of funds, from where he has invested money, then that will be charged, and that has nothing to do with startups or non-startups. In any share issue, that is part of the law. Section 68 provides for it. That can still be charged to tax in the hands of the company. The only exclusion there are two: non-residents. So if your investor is a foreigner, non-resident, the section doesn't apply. Does not apply if your investor is a VCF or an AIF. Then it again does not apply. But otherwise, your investor has to prove his source. There is a change on settlement without acceptance of guilt. In a sense, what we are saying now is last year, Section 37, not last year, but earlier, Section 37 was amended to say that anything which is an offense under law is not allowable. That was always the law. Then they explained what is an offense under law. And then they said whether it is Indian law or foreign law, both will be considered to be offenses under law. So you had the example of Milan Laboratories, which had perhaps violated some patent in European Union. Now they got an income for that in the first place. They had not really violated the patent. They had settled the case of patent violation by taking a fee. They paid tax on that fee because they got a fee by settling that case. 2 years later, they lost the case in the European Union. It came to the conclusion that you never had the patent, so the fee was you were not entitled to the fee. So whatever you settled was unjustified. You had to return. They returned, in a sense. Now that was considered to be a patent violation. And when they returned, they claimed a deduction that was being disallowed. The tribunal allowed it, saying that this is not a violation. And if it is a violation, it's a violation of foreign law. Your section prohibits violation of Indian law. Or that's how they understood the word law. So now they have said, so they amended it last year, Indian or foreign law, or law outside India. Then they brought in one more case, compounding. If you do compounding, even that compounding fee will be disallowed because compounding by and large means you accept that I committed an offense, but I don't want to go through the whole trial. Please take a penalty upfront and let it come to an end. It's like what we said in such cases, pay 60% and you don't have to worry about interest, penalty or any litigation. So that's a compounding type of example. So that was considered to be disallowed. Now they are adding any settlement. Now that's going a bit perhaps too far. Settlement of any proceeding which has been initiated for contravention of an offense. If you pay for that settlement, that will be considered to be something which is liable to be disallowed. This time again, they have only used the word law, they have not referred to foreign law. Though last year they amended it at two places and said Indian including foreign law. Now again they have forgotten that. So hopefully the settlements we are talking about are settlements of Indian law, not settlements of foreign law. Because the major settlements, the huge amounts, are really being paid by pharma companies of the country under foreign law settlements. In particular in the US, claims can run into millions and billions and will have to settle. Secondly, I don't know whether settlement under this will ever be caught because the condition is for contravention after initiation of proceedings. But your settlement deed will almost always say, I don't accept that I contravened. You don't accept that I contravened or didn't contravene. We both agree that without going into finding out whether I contravened or I didn't contravene, I'll pay you so much and we will both withdraw our cases. That's what a settlement document will almost say. So then where is the contravention? Because nobody has bothered to find out whether there is or there is no contravention. This may apply to, in particular to the settlements which are happening with SEBI. I think they will notify that. They have taken the power to notify laws. They have not yet notified the law. Foreign tax credit will now will be considered to be income if you get a set off for it, which I think is logical. The consequences of looking at it differently are not worth discussion just now. Black Money Act, the penalties which were there, the threshold was not disclosing a foreign bank account of up to 5 lakhs was not an offense. They had amended. Now they have said instead of 5 lakhs, 20 lakhs. And not just bank accounts, any foreign assets. So up to 20 lakhs what you have abroad, if you don't disclose in your income tax return, it is not an offense. you cannot be penalized. So that 5 lakhs is becoming 20 and bank account is becoming any asset. There is a provision about setting off and withholding refunds. In practice, nothing of great significance. It only shows an attitude. And the attitude which it is showing is, today the section said, if the officer is of the opinion that giving this refund will cause harm to the revenue, will be disadvantageous to the revenue, then by recording reasons in writing, he can withhold refund for subject to approval of commissioner and all that. Now they are saying, why do you need two things? If he has formed an opinion and then recorded the reasons, that means the reasons will show. So we remove that if he has formed an opinion. We say only recorded reasons. Only recorded reasons means what? He may record the reason that I don't like your face. I mean, now you have put no guidance whatsoever. And what terms can he record reasons? Earlier there was a guidance, but he has to show how it will harm revenue if I give this refund. Now he doesn't have to show that. If he doesn't have to show that, he can withhold the refund without any reason, virtually, just recording something. And then you have a host of other amendments, which I think these will take care of the major things which we wanted to discuss. Thank you. Thank you very much for hearing me so patiently.